Welcome to the Without the Bank podcast, where you and I are going to talk about all things IBC, the business of banking, how to utilize your money, and how this will help you create more wealth. All right, you guys, I am going to get back into the Becoming Your Own Banker book, and we are going to do another chapter review. It's been a while. I've had a bunch of other stuff going on that I wanted to share with you, so here we are. And today we have a big chapter to go over. So those of you watching on YouTube, I got my readers on because I'm old and I can't see anything anymore. And I'm going to reference the book a little bit. And so it is something that, for those of you that are watching on YouTube, look at my book. Like, do you see all the highlights? You guys, when you are learning the infinite banking concept, I really encourage you to study the concept. Go back to the book, highlight things. I had a client that said, I need to put more money in because I listened to Mr. Nelson's book again. And he does have it on audio, so go back and listen. Get it, read it, study it. And so today we are going to go over the creating an entity chapter. And this is a long chapter, so I'm going to just touch on it a little bit. Otherwise, it's going to get super long. But I do want to touch on it because it is a super important chapter. And so Nelson starts this chapter off with the fact that the life insurance companies have to actuarially do some underwriting. They have to actuarially do the underwriting, right? Actuaries have to look at how healthy people are, how much income they make, what is the longevity of their family, how are they spending their money? And as crazy as that sounds, those things all make a difference, especially the health portion of it. We want a pool of people that are healthy. We don't need people that are not healthy. If we had unhealthy people in the mix, insurance costs would go up. So the insurance company doesn't want to take the risk of unhealthy people. It's just not, if you had a heart attack, 2 months ago, they're not going to insure you. They want to make sure that you're going to be healthy. When they do that, and this is a big question a lot of people have for me, is Mary Jo, what does the insurance company do with our money? Because they're just making a bunch of money. How are they guaranteeing us our returns? Well, they're guaranteeing us returns because they take our dollars and what? They put them into bonds, real estate, other small investments. I shouldn't say small investments, but a small percentage of the portfolio is put into other investments so that they then have the money to pay out the dividend or to pay out the death benefit. Good Lord, I can't talk today. To pay out the death benefit. They are great money managers. They know that that policy is going to be there till we're 121 years old. They're going to have to pay out that money. So a lot of people say, well, my financial advisor can do better, yada, yada, yada. Has your financial advisor been doing this for 200 years? Okay, these companies have been around for 200 years. They have had to manage this money for 200 years. They're professional money managers. That's the first thing, that when we look at creating our entity, we need to make sure that the people that we're creating it with know what they are doing with money. We want to make sure that they have healthy people in that pool and they're not paying out more death benefit than what they've collected money for, because that will make an insurance company be insolvent very, very quickly. Then Nelson talks about the fact that in this chapter, he addresses retirement and the fact that that is just a made up thing from Germany. That he said, everybody should retire at 65. So now we have this belief that we need to be retiring at 65. Well, most people died at 63, right? Or most people died at 67. Now we are living to 100, but we retire at 65. Nelson always said this, and I loved it. He always said, show me in the Bible where it talks about retirement. Because it doesn't talk about retirement in the Bible. Nelson worked until the day that he passed away. That is what he loved to do. We all are working so hard thinking we're going to retire at 50. For what, 40 years? We're going to work for 30 and retire for 40? Where does the money come from? Right? We're going to put it in investments and hope that we make some great rate of return? Really? I don't know. So he talks about that. And then he talks about how to fund the policy, and that we are putting a paid up additions rider on the policy so that we can get access to cash right away. It's really about structuring the policy correctly. If you go to a different agent, and I have had this happen, it happens at least probably once a week. We're going to go to a different agent. We're going to buy a life insurance policy from them. They said that they understand infinite banking, but they really don't understand infinite banking. And I look at the policy and I'm like, well, that's completely wrong. So now what? Well, now what? We can't change anything. It's wrong. They did not structure the policy for infinite banking, let alone know anything about infinite banking, because they don't listen to the podcast, they don't read the book, they're not certified, they know squat about infinite banking, but they can sell you a policy. Structuring it correctly is important. Structuring it so that it meets your needs, really. How many agents out there are asking you what your needs are? What are we going to be doing in the future? All that good stuff. There's not one exact way to structure a policy. A lot of people look at Nelson's book and they look at the numbers and go, oh yeah, we can do that. No, those were illustrations. Those were examples of what Nelson is trying to show you. Yet, what are we doing? We're saying, oh, that's gospel. That's the only way you can do it. No, you can't. And so when you have an agent structuring a policy, we want to make sure that it does not mech. And Nelson talks about this in this chapter. A mech is a modified endowment contract. So prior to the mid 80s, life insurance companies you could put as much money in a life insurance policy as you wanted, and it would all grow tax-free. Okay? Nobody ever had to pay income tax on it. Well, now that's not the case. The government came in and said, no. All you millionaires are putting money into these policies and it's all growing income tax-free and we're not getting our share. So you can't do that anymore. So when we set these policies up, we set them up so they don't mech. Here is one thing that I think is really funny, is people will say, well, my policy doesn't mech and this agent set it up for me. Well, I hope it doesn't mech. He put all the money to death benefit. He did not put that money to cash value. So of course it's not going to mech. He's just buying death benefit with it. It's not even going to be a policy that grows anytime quickly, right? What Nelson is saying is that if we have an infinite banking policy, you need to create that entity so that we have as much money going in as quickly as we can, because we have more money compounding, more money earning interest, okay? Then he talks about the misclassification of just general things in life. But you know what's awesome? Is the misclassification of life insurance. Oh, if there is one thing that gets my goat a little bit, it is this. And it is the fact, and Nelson addresses that in this chapter. He addresses universal life insurance. I was just communicating with a guy on TikTok the other day, and he is telling me what a moron I am, because he knows more about life insurance than I do, apparently, because maybe it's his full-time job, I don't know, but apparently he knows more, and this is the worst place to be putting your money and yada yada yada. Well, guess what? Then he tells me all these life insurance companies went out of business in the 80s, and if it's so great, why would that happen? Oh, put the brakes on, Mr. Know-It-All. Oh, so you're talking about stock companies, not mutual companies. Okay, so when we create our entity, we're doing that in a mutual company. You and I are owners. That's part of the entity structure. These companies have been around for 200 years. This policy is not set up to be tied to the market or reflective of the stock market. There is nothing in this policy that depends on some sort of rate of return. Yet that is what he is referencing. So he is not referencing whole life. He is referencing universal, variable, and indexed, which are all crap policies. because they're tied to the market. They have cost of insurance increases. They have management fees. They have expenses in those policies that are paid on the outside of the policy by you, the policy owner. Not figured in. There is no management fee in a whole life policy because there's nothing in the market. So he's not even talking about whole life insurance. He's talking about universal life insurance. Nelson has that in his book. There is a whole section of it in this chapter about how it is not good, why it does not survive. That is not what is intended for infinite banking. Not all of these things are classified correctly. And I call it terminology. Your terminology is not correct. It is not whole life. It is universal, variable, or indexed. It is a variety of the three. They're calling it all kinds of stuff. What happened to just whole life? It's just whole life. It's guaranteed. It's not reflective of the market. It's not tied to the market. Classification is important when you are creating your infinite banking entity. You want a company that does the underwriting. You want a company that has great vital signs financially, they are doing well. You want an agent that understands how to structure a policy. You want a company that is mutual, that has paid dividends, that has been around for a long, long time. You want whole life insurance. You do not want universal life. You do not want anything to do with the market. Because here's the thing. If you want to go play the market with an IRA. Go play the market with a Roth. Go get yourself a 401k. Get yourself some mutual funds. Don't tie your death benefit to a market. I've seen the universal life policies. I've seen the variables and the indexed. A universal could possibly be good. A variable, there's no guarantee. An index, oh, we're not going to go negative. But yet on the illustration, I see negative numbers. Why? Because we're not being told the truth of what's happening in those policies. If you go to an agent or if you look at this book and you say, well, what's my rate of return? Read the book again, because it is not about a rate of return. Oh, man, I get passionate about this stuff. The German passion is flowing, my friends. That is creating an entity. Read the chapter, read the book. Those 5 things are super, super important. And if you think that you're going to use this solely for retirement, you can do that, but you better be sticking in a whole ton of money. I hope that helped clear up that chapter for those of you that have read the book. Again, if you haven't, go get the book. You can go to withoutthebank.com. You can grab the book on my website. You can get it as a bundle with Life Without the Bank. That is going to be a great start for you. Let me know if you have questions. MaryJo@withoutthebank.com. Happy to answer those. Once you read the book, then we can set up a time to visit. I'll see if there's anything that we can do for you, see what's going on in the big picture of everything, not just one little thing. And if I can help, great. If not, no big deal, whatever. Otherwise, thanks for tuning in. Thanks for wanting to learn. I appreciate it. Let me know if you need anything. Have a great day.